You as a Canadian now owe $1.74 for every dollar that you earn. That's $3.07 trillion in national debt. If you're trying to qualify for a mortgage with a car loan and credit cards, you just lost over $50,000 of borrowing power. I'm going to share with you today 12 legal ways to get that borrowing power back so you can get into the housing market. Stats Canada just released Q1 2025 data that should absolutely terrify anyone trying to get a mortgage. Household debt hit $3.07 trillion, with debt to income ratios climbing to 173.9%. I can't even believe I'm reading that. That's $1.7 of debt for every dollar of disposable income that we earn, the highest since 2021. And 75% of that is mortgages, but the other 25%, the 75,000 average in car loans, credit cards, lines of credit, that is killing mortgage qualification. Now, I just went through and found 12 legal strategies that you can use that can shrink your debt ratios enough to turn a mortgage denial into an actual mortgage approval. Some are kind of obvious, some are more creative, and one involves not getting divorced, and I'm kind of only half joking. But here's where this matters beyond just first-time homebuyers. 2 million mortgages are renewing in 2025 and 2026, and many of you are in a position where you've added debt since you've originally qualified. And you might not qualify at your own bank, particularly if you're looking to refinance. So let's go through the math and make sure it makes sense. Let's start with why so many Canadians are getting surprised by mortgage denials, even though they don't understand the actual formulas. I mean, that's the problem. They don't understand the formulas. So let's explain it. Canadian banks use two magic numbers, 39 and 44. And you need to know these. And yes, there are some exceptions. Your gross debt service ratio, that's the total housing cost divided by gross income. And this cannot exceed 39% at most lenders. And then your total debt service ratio, which is your housing plus all other debts divided by your gross income, which basically means all of your expenses monthly can't be more than 44% of your gross income. And this is the part that trips up most people. They calculate it based on their net income, what actually you take home, but banks actually use your gross income, which is like your salary before income taxes. So if you make $100,000, they're taking $8,333 per month, even though you're taking home maybe $5,800 after tax deductions of around 30%. And here's the car loan killer. TransUnion, one of the credit agencies in Canada, reports that the average new car loan in Canada is $38,874, which is actually less than I thought. At 6.9% over 6 years, that's $661 per month. Seems pretty reasonable. It's kind of like what I see every single day. And for someone earning $100,000 with a 5% down payment, the car loan cuts maximum qualification down by roughly $37,000 at minimum. That's minimum, just so you guys know. Credit cards are calculated at 3% of the outstanding balance. So $10,000 in credit card debt means the bank assumes you're paying $300 per month minimum. Even if you have to pay it off or you don't pay it off every single month, they count it as a $300 towards the debt itself. And that also reduces down the qualification, particularly even if you're paying 0% interest. It doesn't matter. All that matters is what the balance is. So let's go through the 12 strategies that you can use for improving your debt ratio. I'm going to rank them by impact and tell you which ones work in the real world versus theoretical. You're going to want to probably save this video, by the way. Number one, the hack number one is to eliminate the car loan payment. This is the nuclear option, but it is still the most effective option. Sell your car, pay off the loan, use ride shares or Turo or something like that for a few months while you apply for the mortgage. Now, again, nobody wants to do that, but I've seen borrowers so many times who take a car loan on right before applying for a mortgage. That's like ordering dessert before stepping on a scale. None of the ride share options show on your credit report, so your debt ratios can actually stay clean. The math, eliminating $661 monthly payment is worth anywhere between $80,000 to $100,000 in total mortgage capacity. And that could be the difference between qualifying for $450,000 versus up to $525,000 to $550,000. The second hack is family gift for credit card paydown. Lenders, they estimate credit card payments at 3% of the balance, which means you pay down the $10,000 with family help. Eliminate the $300 means you qualify for a significant amount more. And this matters because about 40% of first-time home buyers already rely on family assistance for the purchase anyways. I mean, it's not really unusual. We see it all the time, and it's become standard. A survey from BMO found that 43% of them people could not have purchased a home without family help. The $300 monthly savings translates to close to about $35,000 in additional mortgage capacity, and it's not a if it's a gift, not a loan, there's no repayment obligations counting as debt either. You don't have to go through any paperwork or anything like that. Number 3, consolidate with what's called a peer-to-peer lender. There are companies out there, I won't name them, as they specialize in converting high monthly payment debt and revolving debt into lower monthly payment obligations. So basically, you kind of pay off one debt with another debt, but the payments are lower. For an example, you could say take a $25,000 credit card, which might have been $750 on a monthly payment, and you can consolidate that into a monthly loan, which would be showing up as $450 per month, which brings you back about $300. Again, supporting the opportunity to give you about $35,000 left of borrowing power. Plus, on top of that, paying off the revolving debt in installment services actually reduces your overall credit utilization, which can actually help your credit score. Basically, a better score could mean having better mortgage options. Hack number 4 is avoiding high condo fees. People don't think about this, but when you get pre-qualified, we kind of use a set series of strata fees depending on where you're buying. And it's more of a shopping strategy, not so much like a debt fix. 50% of condo fees count towards your debt calculation when we looked at that GDS number. So a building with a $700 monthly fees is costing you $350 a month in borrowing power versus, say, $300 in fees only costing you $150. Nothing says financial regret like paying a $700 month for a sauna that you are never going to use. So the $200 difference in condo fees is a significant difference, $15,000 to $20,000 again in purchase price that you can afford. Hack number 5, getting a family gift for a larger down payment. Different strategy with the same source. Instead of using the family money to pay off the debt, use it to increase the down payment. Smaller mortgage or up to 20% increases qualification. And with more families considering the possibility of an early inheritance, let's be honest, why not? If you're going to get into the market, your family would probably rather see you do that than the alternative. Hack number 6, remove yourself from all joint debts. You would be shocked how often I see people that have signed on to their ex's car loan or brother or sister or something like that. Even if they make every single payment, it doesn't matter. If you co-sign with something, it's your debt. Remove it before you even bother applying. A $20,000 signed car loan, $400 monthly payments is costing you $50,000 in mortgage capacity. Contact the lender, request approval, get it transferred out of your name right away. Hack number 7, pay off the debts that are almost matured. If you have a loan with like 3 months to 6 months left, banks still look at the whole monthly payment. They don't care if you only have $2,000 left. So use your savings, pay off those loans that are almost finished. The $15,000 that is remaining with 5 months left, or whatever that period of time is, just pay it off early and open up your borrowing capacity. Hack number 8, convert personal to business debt. Now, this doesn't work for every lender and every person, so there's a big asterisk. But if you are self-employed and you own a company and you have personal debt that is legitimately business related, move it over to the company books, and you can, in some cases, get it out of your name. I will put a caveat in there. This must be a legitimate business expense, and it requires professional accounting. For tax implications, do not mess with this. Fraud does not end very well, so please be safe on these numbers that we're sharing today. Hack number 9, add a cosigner. Asterisk again, not every cosigner is good. Get a cosigner who has good income and minimal debt. Remember, their mortgage is a debt, and this can help to improve your qualification ratios to add their income to an application. This is really common for first-time buyers, but I'm seeing it more and more and more for friends and family members that are not necessarily first-time home buyers. Warning, however, if you are going to co-sign for somebody, this is your debt now, and it is your borrowing capacity or the person that's coming on there. Hack number 10, buy with a mortgage helper. Property with a rental suite generating $1,500 a month. Lenders can allow you to use typically 50% of the rental income, with some being as high as 85%. That's like an extra $750 plus of additional mortgage qualifying income. That can help you borrow more to buy a higher priced property if you're having trouble getting over the line there. Hack number 11, Look at a lender with a broader income recognition. Not all lenders treat income the same, and there are different types of lenders. We work with a series of self employed or alternative type lenders that accept bank statement income for business owners and entrepreneurs. And some of them allow more rental income. Some of them allow a higher debt ratio. Some of them allow tips and commission calculations and bonuses. And this is really where, as a mortgage broker, we earn an additional keep. Not only do we service our clients incredibly well when it relates to conventional mortgages and know way more about the lending process than the person that just walked into the bank. I mean, the person that works at the bank that probably hasn't actually figured out how to qualify professionally on their own. But we know which lenders are also more flexible on specific income types. And it could mean the difference between getting approved and getting declined. Hack number 12. Now, remember, this is not professional advice. Don't get divorced. Alimony and child support payments can sabotage a mortgage approval letter faster than your ex changes the Wi-Fi password. I'm kind of half joking, but it's real. $2,000 a month of alimony and child support can cost you hundreds of thousands of dollars in mortgage capacity. Divorced borrowers face higher qualification standards. Now, here's why. Those are the 12. I got more, but that's 12. Those are good. Here's why those hacks matter more than just first-time home buyers for the millions of Canadians that are renewing their mortgages in 25, 26, and 27, and why many homeowners cannot requalify at their bank, nor should they, because they're going to be in a position where they need to reduce their debt. Let me give you a scenario. So you bought in 21 at a 1.79% 5-year fixed with a total debt ratio of, let's say, 38%, comfortably under that 44% limit. But since then, you bought 2 cars, opened a credit line, maybe had a problem, a financial situation, you've got some credit card debt, and you're renewing at 4.09%. Your mortgage payment goes up from $2,240 to over $3,000, which is a $1,000 plus difference in payments. But that's not the problem. The problem is your TDS score is, with all the new debts that you acquired, 54% instead of 38%. And I'm seeing this every single day right now. You're over limit by like 10 percentage points. And even for those lenders that will give you up to 46 or 48, what do? What happens? So your bank might renew your mortgage at their best rate, which is awesome, but they might end up just sending you over to an alternative lender with no advice, or they might force some other options like interest pay down, or worst case, they force you to sell because you can't renew it. And that's why cleaning up your debt ratio matters now more than ever. Or if you're in this debt position, contacting us, not a pitch, but let's be honest, like, contact us so we can help you restructure this so you do get best rates and terms in the next 12 to 18 months. Use the hacks or sell the car, pay off the credit cards, remove yourself from co-signers, basically get ahead of all these different options when it comes up to your renewals. Now, when the hacks are not enough, we've got a couple more, and we're going to keep these pretty short. Brokers do have access to strategies, including some other alternative lenders, but they can come with additional trade-offs. Some lenders will accept up to 55% total debt service ratios. Will you get approved, and the rate will be at around 0.5 to 1.5% higher. There are equity programs. If you have a significant amount of money of assets but low income, there are lenders that will use your assets to help you qualify up to 60% total debt service ratio, or even higher, depending on how much money you have in access. There are some lenders that will use lower qualifying rates. I still probably a bit nervous about those types of lenders, but something to consider. But yeah, I mean, basically qualifying for a mortgage and comfortably paying it are two separate things. Massaging your ratios just to slip past underwriting is like celebrating extra legroom on a flight that you had no interest or need taking in the first place. So the reality of Canadian mortgage qualification in 2025 is this. Canadians owe $1.74 for every dollar of income they have, $3.07 trillion of debt, with 75% of it in mortgages right now. The other 25%, $750 billion is in car loans, credit cards, lines of credit, and that's what's killing mortgage qualification for families. The average household income is carrying $75,000 of debt. Those hacks that I shared with you today can help you not only qualify for more, but reduce your total interest. But the biggest hack out of all this is to make sure you're not just qualifying it, but the truth is that you can actually afford these payments. And if you're one of over 2 million Canadians coming up for renewal in 25, 26, or 27, understand that requalification is a real thing. And this is a time that you need to get your debt under control. And if you added debt, don't wait for the maturity date or this crisis to hit before you're in this tough position. Now, if you found this information helpful, go ahead and hit that subscribe button so that I can continue to help you understand what's going on in real estate, how to qualify, and save money on your mortgages. You can also find me on Instagram at The Mortgage Pug or at Flow Mortgage Co. And I'll see you on the next one.